Welcome, you're watching the NWR Virtual Investor Small Cap Conference, August 2020. We're joined on the line by Think Childcare. Think aims to provide fair value childcare with benefits of corporate ownership in the rapid growth and consolidation phase of the childcare sector in Australia. The company started with just 2 centres in 2001 and now owns and manages nearly 80 childcare centres across Australia, with plans to add further to this network over the next 2 years, with the acquisition of 6 centres in Victoria, South Australia and Western Australia announced in early July. We'll now hand over to Managing Director and CEO Mathew Edwards. Mathew has been involved in childcare since 2001 and has extensive experience in business strategy and management of multi-site businesses, as well as retail and commercial property roles. Mathew has experience in childcare, which includes developing processes for finance, HR, administration and marketing that are robust and provide information in real time. With Mathew is Janny Saliba, who is Think's CFO. Over to you both, Janny and Mathew.
Good afternoon all. Just on our cover there is one of our services in the Premier Office Tower in QV1 in Perth. It's a service we opened as a greenfield service and it's now sort of trading in the high 90% occupancies, and we'll take you through a little bit further in terms of what we actually do in terms of when we incubate a service and open up our brand new services. Think Childcare is the only national operator of a premium group of childcare services, and we're also the nation's largest developer of leasehold childcare services. We started with 12 services that we owned and operated, and going into the IPO, we acquired 18 services that were at low occupancy that required a considerable amount of CapEx and marketing to trade those services up. Where we are today is we operate 75 childcare services across the country, and we've transitioned the vast majority of our services to our premium brand, which is NIDO Early School. We're currently the biggest developer of childcare services in the country, and that is leasehold development of childcare services. And what that allows us to do is control our own supply of childcare services and therefore control our own growth. Just a bit about why childcare exists as a sector. Childcare is predominantly a driver of workforce participation. Over 2 million workers currently rely on childcare to allow them to participate in the workforce and therefore to be tax-paying citizens. It's for this very reason that childcare over the last 30 years has seen bipartisan support and seen an increase in funding to the sector. Today, childcare subsidy, which is in place, means childcare is the most affordable it's ever been in the history of Australia. The educational benefits of childcare are now undisputed, with many national and international studies showing that 85% of your entire learnings occur in the first 5 years of life. It's a foundation in which determines who you will become. And as a factor of that, childcare now sits under the education portfolio and is far more integrated into school environments. So that transition from childcare to school is far more seamless than it used to be. We started our journey operating your typical suburban childcare service, and in 2007 began the transition from a average childcare operator to a premium childcare operator. That required a large capital investment on our behalf, and we embarked on about a $10 million investment across our 40-odd services at that point in time, which was between a $400,000 and a $1.3 million investment per site. Other operators in the sector were spending somewhere between $40,000 and $80,000 to upgrade their services, which was a few resources, a bit of a tidy up, a bit of paint, etc. But what we sought to do is fully transition our average services to premium services. We also did a lot of work on the quality of education and invested very heavily in terms of lifting the quality of care, the quality of training to our people. Every ELK, which are our early learning and kinder brand services, that transitioned across to NIDO, we took our educators through a 3-month journey in order to lift their skills and their understanding and deepen their knowledge in terms of early education. We developed an operational platform, which we invested heavily into, and we continue to do so, just to allow us to actually deliver high quality care at scale. We've employed a support team over the years to essentially allow us to become the company we wanted to be, not the company we were. This sort of hit our earnings for a couple of years, but we're now starting to see the sort of scale benefits of that investment. In terms of our systems, we've developed sector-leading systems with our education curriculum, our training, our data analytics, our employee support structures, which are allowing us to deliver sort of high-quality care at scale. The value proposition for NIDO is we offer premium education and environments accessible prices. Typically, our services could sit very comfortably in a Toorak or a Mosman Park or a Mosman, yet we seek to build our services in suburban areas. An example is Greenwood in Western Australia, Airport West in Victoria, and Seven Hills in New South Wales. Our focus is on a premium education service. A high quality education attracts more families, therefore lifts your utilisation or your occupancy and your profitability. It also attracts a better quality of employee. The whole investment is a way of cycling up your performance. It means that you have to incur a cost at the start, and that cost we started incurring about 3 years ago, and we're now seeing the benefits of that. So I guess in essence, we're a premium provider in terms of the quality of education, the quality of our environments, but we don't sell it at a premium price. We sit very comfortably within our local suburban areas, and predominantly circa 90% of our families receive a subsidy, with families paying as little as $16 per day for a premium quality service. We've traded through the COVID period, and I'm sure there'll be some questions in regards to what's happening in Victoria and how we see that, and happy to answer those. Effectively, coming out of COVID, the government is paying us a 25% subsidy, that being 25% of our occupancy in February, which for us has us sitting around a paid occupancy of around 80%. We do expect there will be some adjustments for Victoria over the next week in that regard. The challenge for families at the moment is the alternate care deliverers in terms of grandparents and aunties and uncles and friends is now being removed, and we don't see sort of that trend returning for a little while. The childcare sector was the only sector in which government guaranteed income, and as well as reduced our operating costs by giving us JobKeeper. Without childcare, millions of people couldn't attend work, which would have extended the recovery of the economy quite considerably. In the UK, where childcare wasn't supported initially, essential workers, nurses, doctors, fire, factory workers, supermarket workers couldn't attend work because care wasn't available, and as the Australian government ensured they didn't follow that path. They provided us 50% of our income from the last 2 weeks of February, and also then allowed us to achieve compliance with the JobKeeper regulations. The aim of the two packages being the child care relief package and JobKeeper was to put us at about 85% of where we would have normally traded, effectively putting us, in their eyes, at around a break-even position to maintain our viability through the pandemic.
The graph on your left, or the line graph there, the dark grey is enrolment, and the green line is attendance. And what you can see there is attendance at the sort of peak of COVID and how it ramps up through the months of May and June to get to 64% as compared with 74 enrolments, but ahead of, or slightly ahead of, pre-COVID levels.
So how we are growing as a company is vastly different to anybody that has come to market, any listed childcare operator. Our competitors buy on market childcare services at between 5 and 7 times earnings. They face the challenge of integrating, independently owned childcare services or a group of childcare services with a corporate structure. And where they sort of derive value is the multiple paid for the acquisition versus the multiple they're trading at as a public company. In the sort of competitive landscape there is at the moment, there's a limited right now the availability of quality businesses to acquire at a price that are accretive. And effectively, your growth is purely determined by what's available for you to acquire. We moved several years back to a model which meant that we either internally develop our own assets or we work with external developers who develop our services under the NIDO brand, and then we seek to acquire off them. We talk about our internal incubation strategy and our external incubation strategy. In order to facilitate the internal incubation strategy, last December we launched and concluded the listing of TND, which is an entity which is stapled to TNK, forming Think Childcare Group. TND is purely a developer of greenfield leasehold childcare services, which it takes the trade-up risk, and once it trades above that 75% occupancy and that $300,000 profit, it seeks to then sell that asset into TNK. TNK is around 80% on the journey to becoming an operator of high quality, high occupancy, high profitability childcare services. We don't develop new childcare services anymore in TNK. Therefore, we don't bear the trade-up risk of developing childcare services. And as I said, we're in the final throes of completing the transition of all our services across to the NIDO brand. You'll see that we have the two entities being TNK, being Think Childcare, and TND being the development arm. Each entity can now be banked separately with a different risk profile, and therefore our banking is priced accordingly. And currently the equity structure is 90% TNK, 10% TND. What the staple structure allows us to do is quarantine the trade-up risk into TND. So if we find a site that doesn't work, it's sitting in TND, and it doesn't then affect the performance of TNK. It also ensures from a development perspective that our growth is controlled by us, and we're not at the behest of market conditions or the availability of providing services. So we can actually control and look at where we're sort of going over the next 3 years in terms of our development. In terms of developing the assets, because we're developing them effectively internally within the group, we're then not paying that 5 to 7 times goodwill or 5 to 7 times earnings, of which 90% is goodwill, to a third party, into an external party. We get to sort of minimise that leakage of goodwill to third parties. Because of that, we also get to recognise, because we're buying it from TND into TNK, we get to recognise the goodwill we create within within the group on the T&K balance sheet. Currently, we have around 50 childcare services in our pipeline, of which there are 26 services sitting inside the TND, and that has an end value of around 56 million at 4 times, that being 4 times earnings. We currently have 4 services in trade up under TND. And the benefits of incubating and developing internally is there's no integration risk. We're effectively paying a multiple of 1 times earnings because our cost base, and we'll show you the example in a minute, is around 1 times earnings. We've got proven assets, they're purpose built, and we've got consistent high quality. If we look at the external incubation services, we get the same benefits of those. There is a goodwill leakage because we are buying off our external parties. If we find the sites, we open the sites, we market the sites, and we trade the sites up on behalf of our third-party incubators. They bear all the operational trade-up costs and all the CapEx, and obviously all the risk that goes with that. We have a call option to acquire those assets at 4 times earnings, where they achieve our minimum 75% occupancy and minimum 280,000 EBITDA. We have an earn-out where we'll pay up to 25% above the initial purchase price agreed, but we also have a clawback arrangement that we can claw back 100% of the purchase price based on the first 12 months of our ownership. That ensures that when we get to our end of our first 12 months, we've only ever paid a maximum of 4 times earnings for those assets. Our current incubator partners have around 30 services in development, of which they expect to deliver to us over the next 36 months. Just an example of a incubation service that came through. This is a service that we actually acquired, but the same thing applies to our internal development within T&D. The initial purchase price for us was 1.5 million. We had a target of 469,000 annual EBITDA for the earn-out and the purchase price. It actually achieved 483,000. For us, it meant our effective acquisition price was 3.9 times earnings. There was a capital cost for the developer of this site of 450,000, which meant they created over the 12-month period 1.35 million in a capital gain, or if that was a T&D developing, we would have created 1.35 million of goodwill internally. And as you can see from that equation, you're paying around 1 times the earnings. I guess looking at the investment proposition of Think, over the last few years, we've continually increased our performance. Even though we've continued to sort of invest heavily back into our infrastructure, into our systems, we've opened up some greenfield sites that were loss-making within T&K. We took a conscious decision to actually invest into our systems and our processes, that CapEx piece, in order to build something today that was going to be more consistently delivering distributions for the future. We're starting to now see the benefits of that CapEx and operational focus beginning to be realised. However, we don't believe the market is yet to price that into our share price. We have a stapled structure which is very unique, which allows us to quarantine the risk of trading up childcare services away from our main operating entity, and it allows them to be, as we spoke of before, banked accordingly. Childcare is a key driver to workforce participation, as evidence that we were the only sector in the country to have our income guaranteed. And as the economy seeks to recover, there'll be far more reliance on the sector going forward. This is just a shot to close off of one of our childcare services in Port Melbourne. This 62 fastback Mustang has been all over the world and to the moon and back with the children. So I'm happy to take any questions you may have.
Thanks very much, Matthew and Jenny. We have some questions that have come through. Firstly, maybe this is an easy one to answer. What attendance do you need for break even at your centres?
We operate our break-even model around 50-55%. That's 50 to 55% paid attendance.
Good to know. And how much can the corporate head office cost support in terms of services EBITDA? That one just came through from Shu Young.
So if we look at our current model, and to give you an example, if we were to acquire 10 new services, and you're looking around sort of $4 million EBITDA for those 10 services, we would put on maybe one person in finance and one person operationally in the field. So you're looking at probably around a $400,000 cost to bring in another $4 million for the EBITDA.
I don't know how conclusively you can say the impact of yesterday's announcement of Stage 4 in Victoria will have on the business just yet, but would you maybe be able to, wager an educated guess on the impact of that announcement on Think as a business?
So there's a transition payment coming out of COVID-19. We currently receive 25% of our income from February, the last 2 weeks of February, and we receive that until the end of September. We also receive childcare subsidy for families that are not attending but have a COVID-related absence. We expect that the government will probably increase that 25% funding to 40%. They've just done that for out-of-school hours care, and that will put us probably around the equivalent of 70+% paid occupancy through the lockdown in Victoria. The piece for us is that they want to ensure that our services remain open to be able to accept no longer essential workers, but effectively approved workers and children with either special needs children or children that are vulnerable. So there's a requirement they want us to see all our services remain open and trading through the crisis.
Yeah, so just to confirm, we're expecting more clarity around that tonight, most likely, or at some point this week. Can you maybe talk about... Yeah, great to know. Thank you for that. Can you maybe talk about the debt situation of the business, even if Jenny would like to address that for us?
Current debt and headroom facilities?
So look, obviously we're a few weeks out from announcing our results. What I can tell you is that we have significant headroom in both our facility as well as from a covenant perspective, and we've had a strong position through the entire sort of COVID period.
Thank you for that, Jenny. So we'll be waiting to hear more from the government throughout the week in Victoria at least, and then we'll await your results in the coming weeks as well. Thanks for joining us today.
Thank you.
Thank you all.